Hello, I'm Frank Kopfinger, Head of Investor Relations and Strategy at LEG. With our half-year 2025 results, we provided the markets with a couple of highlights, which I'm going to address in this short video. First, based on a strong set of financials in H1, we upgrade our guidance and narrowed our AFFO guidance to the upper half of the original range, i.e. to 215 to 225 million euros. This suggests now, based on the midpoint, a 10% improvement over the previous year. Secondly, as the AFFO is more of a cash flow number, and the focus on AFFO allowed us to successfully manage through the cycle, we also provide now markets with an indication on FFO I. FFO I, which is the key earnings number in the sector, will be in a range of 470 to 490 million euro. This suggests a 5% increase over the last year. Thirdly, our guidance upgrade is driven on two factors. A much faster integration of BCP, and B, a better value-add business, especially coming from the energy entity where we provide energy services to tenants. Both drivers allow us to also increase our EBITDA margin to 77% from previously 76%. Fourthly, our financing remains strong. We continue to run our financial debt at a very attractive average interest cost of 1.54%. at an average maturity of 5.5 years. And fifthly, we saw valuation uplifts of 1.2% for the portfolio, and it confirms our view that valuations are slowly coming back. It is the main driver for the increase in NTA by almost 4% to 130.87 euro. And this presents a discount of around 44%. If I take the current share price of 73 euro into account. Let me walk you now through those financials. As I said, we had a very strong start into the year. We achieved an AFFO of 127 million euros, which represents an increase of 15% over the last year's period. It is driven by several factors. First, the rent level grew by 7%, driven by the acquisition of BCP, but also by the like-for-like rent growth of 3.2%. Second, we had a broadly stable cost base, and this is why we increased our net operating income by almost 10%, and our EBITDA grew by even 11%. This resulted in a strong EBITDA margin of 78.6% for the first half of 2025. Third, we continue to benefit from low cash interest costs, which remained low at 1.54% for our entire debt book of around 10 billion euro. And all this drove up FFO I by 11%. The AFFO grew by 15% to almost 127 million euros. You should, however, not take the strong AFFO level in H1 as a run rate. The key driver is our CapEx spending, and we will continue to ramp up our spending there, and this is why you should expect now the AFFO level in a range of 215 to 225 million euros. So we integrated BCP's 9,000 units with a very complex structure and an Israeli listing much faster than we originally expected. The company has been delisted from the Tel Aviv Stock Exchange in Q2 and is now fully integrated. This helped to faster realize operational but also financial synergies. Therefore, BCP already contributes to the strong development of EBITDA, FFO I, but also on AFFO level for the entire group. While originally we expected BCP to have only a neutral effect on the AFFO, we now expect more than 5 million euros of contribution on an AFFO basis. Let me now come to valuations. By now, we feel very confident that the devaluation cycle has come to an end. Following the slight uplift at year-end 2024, we saw a valuation result of plus 1.2%. This is slightly above our original expectation. All in all, we expect this trend to continue. However, we continue to rather see a U-shaped recovery, and we are at the early stages, rather than having a V-shaped recovery from here. The gross yield of our residential portfolio is 4.9% and is still offering a decent spread to bond yields. The net initial yield for the portfolio based on EPRA definition is 3.8%, and the average gross asset value per square meter for our residential property stands now at €1,656 per square meter. And with this, I come to our financial profile. We believe we are well positioned in the current environment where we saw a high volatility on bond markets. All our remaining 2025 maturities have been already addressed for quite some time. The remaining debt mainly relates to our €400 million convertible, which is due on September 1st, and which we intend to repay and where we can rely on our very strong liquidity position. At the end of June, we had around €764 million of cash and cash equivalents, including short-term deposits. Furthermore, there is an undrawn revolving credit facilities adding up to €750 million, plus an unused commercial paper program of €600 million. We are now focusing particularly on refinancing the 2026 maturities already, continuing our opportunistic approach. Technically, 60% of the 2026 maturities are already covered by liquidity or signed loans. Our average interest rate stands, as I said, at 1.54% at the end of June, below the previous year's figures of 1.6%. The corresponding maturity is 5.5 years. And then let me finally walk you through our new guidance for 2025. The excellent operational results, the seamless integration of BCP, and the attractive financing structure of our group contributed to the presented strong set of financials. Therefore, we were able to adjust some elements of our guidance. Firstly, we expect the EBITDA margin to improve by 100 basis points to around 77%. And secondly, we narrowed the original AFFO guidance range towards the upper half, in absolute terms to €215 to €225 million. This translates into an increase of our core KPI, the AFFO, for 2025 by around 10%. As we have clearly passed the turning point for valuations and see a further stabilization of values, we provide also an indication for the FFO I for the full year. We expect the FFO I to be in the range of €470 to €490 million. And this translates into a 5% improvement over last year and will shift earnings capacity towards pre-crisis record levels. Otherwise, we keep all other guidance items unchanged. And with this, I come to the end of the short video. I hope I gave you a good overview on our second quarter results, and you certainly find the entire reporting set on our webpage within the IR section. Should you have any questions, then please do not hesitate and contact me or the entire IR team. Thank you.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.